Current market price is $104.28 USD. Market status is closed. Data as of Friday, November 21st, 2025, close. Day change plus 1.58, plus 1.54%. You're looking at a closing price of $104.28 for the Walt Disney Company, ticker symbol DIS. While the market is currently closed for the weekend, the tape from Friday tells us a fascinating story, closing up 1.54%. But don't let that modest green number fool you. It is merely a Band-Aid on a much deeper wound that has been festering in the mouse house for the better part of this quarter. Expectation in this market is a powerful drug. The expectation surrounding Disney right now is that the turnaround promised by Bob Iger is fully baked in, that the cost-cutting measures have saved the ship, and that we are ready to sail into blue skies. Investors want to believe that the legacy media giant has successfully metamorphosed into a digital-first growth engine. That is the expectation. The reality, however, is far more abrasive. The reality is that Disney has become a master of efficiency, but is struggling to remember how to be a master of growth. We are seeing a company that can squeeze a penny until it screams, delivering earnings beats that look fantastic on a headline, while the actual top-line revenue, the money coming in the door from customers, is stalling out. The divergence between their ability to cut costs and their inability to significantly grow sales is the exact friction point that is keeping this stock pinned in the low hundreds. And if you are not paying attention to the revenue misses, you are missing the entire story. Let's get granular on what happened this past week and why this price point of $104.28 is so critical. We just came out of the fiscal Q4 2025 earnings print, and the reaction was telling. Disney reported earnings per share of $1.11, which handily beat the Street's forecast of $1.05. On paper, that looks like a victory. It's a nearly 6% surprise to the upside on profitability. If you were just reading the headlines on your phone, you might have thought, great, Disney is back. But the stock didn't rally to the moon. It actually faced significant selling pressure earlier in the week before stabilizing on Friday. Why? Because revenue came in at $22.5 billion, missing the target of $22.75 billion. This matters because in the current market environment, Wall Street has stopped rewarding companies just for firing people and cutting budgets. The efficiency trade is over. Now the market demands growth. And Disney's revenue miss signaled that despite all the price hikes at the parks and the ad tier rollouts on Disney+, the consumer is pushing back. When you see a company beat on profit but miss on revenue, it usually means they are raising prices to mask slowing demand. That is the curiosity loop we are stuck in right now. How long can Disney keep raising prices at the parks and on streaming before the average family simply taps out? Speaking of tapping out, this is where the retail versus institutional dynamic gets really interesting. If you look at the flows on platforms like Robinhood, you often see a surge of buying whenever Disney dips near $100. There is a massive amount of nostalgic capital that treats Disney like a family heirloom. Retail traders using the Robinhood stock trading app or engaging in Robinhood stock trading often view these dips as sales on a forever brand. They see the intellectual property, Marvel, Star Wars, Pixar, and they assume the stock must eventually reflect that value. However, if you look at the institutional side, the flows you might see through Interactive Brokers or Fidelity Investments, the story is more cautious. The big money managers are looking at the margin compression in the linear TV business and asking if the streaming profits are growing fast enough to replace the dying cable cash cow. The most significant recent development, one that hit the wires just days ago, is the confirmation of dynamic pricing coming to the U.S. theme parks. CFO Hugh Johnston confirmed this at a recent conference, and it is sending shockwaves through the fan base. We are talking about a surge pricing model similar to Uber, where ticket prices fluctuate based on real-time demand. While this is financially brilliant for maximizing yield per guest, something that a Fidelity wealth management advisor might nod approvingly, it risks eroding the brand equity that Disney has built over a century. The tension here is palpable. Disney needs to extract every dollar from the parks to fund its content engine, but by treating the Magic Kingdom like a commodities market, they risk alienating the very families that make the ecosystem work. We have to talk about the streaming numbers because that is the battlefield where the war for the future is being fought. The direct-to-consumer DTC segment operating income was up 39% to $1.3 billion. This is the reality exceeding expectation part of the equation. Just 3 years ago, this division was bleeding billions. Now, it's a legitimate profit center. The data shows that the bundle is working. 80% of ESPN's streaming subscribers are taking the bundle with Disney Plus and Hulu. This reduces churn, which is the silent killer of streaming services. If you are using SoFi Invest to build a portfolio of media stocks, you have to look at churn rates. Disney's ability to lock people into an ecosystem where they get sports, news via ABC, and entertainment is its moat. It is finally starting to look like a coherent strategy rather than a panic reaction to Netflix. However, looking at the charts, the stock is sitting at a precarious level. The $100 level is a psychological fortress. Every time it breaks below that, buyers step in, but the ceiling is lowering. We used to talk about resistance at 120, now 110 feels heavy. The 200-day moving average is looming overhead, acting as a lid on the price. If you are a technical trader using interactive brokers trading platforms, you are seeing a compression pattern. The Bollinger Bands are tightening, which usually precedes a violent move. The question is, which way? Let's zoom out to the macro picture. We are in late 2025. The economic data has been mixed, with consumer spending showing signs of fatigue in the discretionary sector. Disney is the ultimate discretionary stock. You do not need to go to Disney World. You do not need Disney Plus. When inflation bites, these are the first things to go. The fact that Disney's revenue missed estimates is a macro signal as much as it is a company-specific issue. It tells us that the middle-class consumer, the bread and butter of the mouse, is tightening their belt. This creates a headwind that no amount of creative accounting can fix. But here is the contrarian take that might force you to rethink this. The impending exit of Bob Iger in 2026. We know now that James Gorman is taking over as chairman in January 2025 to oversee the succession. The market hates uncertainty, and the "who's next" question is a dark cloud. But what if the next CEO isn't a creative visionary, but a cold-blooded operator who sells off the linear TV assets entirely? There is a scenario where Disney sheds ABC and its cable networks, becoming a leaner, pure-play content and parks machine. That would be the catalyst that sends this stock back to $150. It's the breakup thesis, and it's gaining traction in quiet corners of Fidelity brokerage discussions. I want to pause here and ask you a question, because this debate is heating up in the investor community. Comment below how many shares of Disney you currently hold, and do you think the new dynamic pricing at the parks will make you less likely to visit? I really want to gauge the sentiment on this because the disconnect between Wall Street's love for yield and Main Street's hatred for price hikes is at an all-time high. Continuing on the business model, we have to acknowledge the content slate. The success of Inside Out 2 and Deadpool and Wolverine from the prior fiscal year, but still impacting the comps, proved that Disney can still hit home runs. but the studio business is lumpy. You can't bank on a billion-dollar hit every quarter. The real steady hand has always been the Parks, Experiences, and Products division. This division has historically been the bulletproof vest for the company. But recently we saw international parks soften. Disneyland Paris and the parks in China have seen attendance dips. This is worrying. If the U.S. consumer falters while the international consumer is already pulling back, the double engine of growth, parks and streaming, becomes a single engine trying to pull a very heavy train. Let's discuss the role of automated investing here. If you use Schwab Intelligent Portfolios or SoFi Robo-Advisor tools, you might find Disney is often included as a value play or a consumer discretionary staple. These algorithms rebalance based on fundamentals, and right now,